Okay, let's dive straight into this. Welcome to today's explainer, where we are looking at the anatomy of a literal disruptor. By mid-2026, one platform had completely rewritten the rulebook for decentralized exchanges, Hyperliquid. Dominating crypto derivatives is no joke, but these guys, they didn't just enter the arena, they absolutely took it over.
So, that brings us to this incredibly fascinating central mystery. How exactly does a completely self-funded decentralized exchange beat giants like Ethereum and Solana combined in key metrics? We're not talking about some massive, sprawling corporate tech giant here. We are looking at a hyper-lean, total underdog team of maybe 20 to 30 people. Honestly, mostly Harvard quants, with deep backgrounds in algorithmic trading. The sheer improbability of this David versus Goliath setup is wild. Yet this tiny crew built a network that processes more perpetual volume than established industry titans.
To really wrap our heads around how they did it, you just have to look at this single, staggering number, 200,000. That's the number of orders per second their core engine can process. It's just a massive data-driven wow moment. To put that into perspective, most decentralized exchanges can handle, maybe a few thousand operations per second if they're lucky. Hyperliquid is operating at a scale that actually rivals traditional centralized exchanges, and they're doing the whole shebang fully on-chain.
And that raw technological firepower is exactly why the hype is so real. This whole movement is backed by massive adoption and seriously heavy capital. By mid-2026, their ecosystem hit a mind-blowing market capitalization of over $16 billion. They managed to capture the attention of hardcore professional traders by delivering that centralized exchange-like speed, but without ever forcing users to hand over custody of their actual assets.
Let's move to Section 1 and see how this builds. The engine, unpacking the tech stack.
Right, so none of that massive volume is even possible without a completely reimagined architecture, and that starts with HyperEVM. Basically, this is an Ethereum-compatible smart contract layer built directly into their Layer 1 blockchain. What that means for builders is they can interact with the spot and perpetual order books natively. We completely bypass those clunky, highly vulnerable bridges that usually glue separate chains together. It is all just baked into one lightning-fast execution environment.
But of course, speed requires instant network agreement, which brings us to HyperBFT, because let's face it, in trading, speed is literally money. This custom consensus protocol achieves deterministic one-block finality. They use this incredibly clever feature called optimistic responsiveness, meaning the network moves as fast as the validators can communicate. There are absolutely no multi-block delays here. When a trade happens, boom, it's settled instantly.
When you put this architecture side by side with your typical Layer 2 rollups or app chains, the user experience superiority is night and day. Those older platforms, they constantly suffer from high gas fees per trade and multi-block delays, mainly because they eventually have to settle all that data on a slower main chain like Ethereum. Hyperliquid gives you sub-second finality and zero gas fees on trades. You're not paying a network penalty every single time you place or cancel an order. It's a completely frictionless trading environment.
Now, what's really interesting about this next slide is Section 2, the fuel, tokenomics without the VCs.
In an industry where massive VC bags usually suppress token prices and just leave everyday retail investors holding the bag, check out the glaring absence right here. Zero venture capital allocation. Literally none. It's almost unheard of in crypto. Instead, 31% of the entire 1 billion token supply went straight to early users through an airdrop. That's roughly 94,000 users. So nearly 70% of this network actually belongs to the community, making sure the platform's success is tied directly to the people actively trading on it.
Section 3, the black hole, the automated buyback engine.
Handing out tokens is just half the equation, right? The other half is the assistance fund, which acts like this giant automated vacuum cleaner that relentlessly consumes tokens right off the open market. The economic loop is satisfyingly simple. The platform generates these massive trading fees. An unbelievable 99% of those fees are routed directly to the assistance fund. And then that fund automatically buys back hype on the open market. It's just pure automated economic recycling, feeding revenue right back into the ecosystem. And the scale of this is genuinely mind-blowing. $65 million. That is the isolated monthly revenue flowing straight into the ecosystem as of early 2026. Think about it. When your protocol is doing billions of dollars in daily volume, that 99% fee recycle turns into massive, unstoppable buy pressure. For anyone studying tokenomics, this is an absolutely crucial takeaway. It makes Hyperliquid one of the highest holder revenue protocols in the entire space. All of this creates some incredibly powerful deflationary drivers. First, you have those fee-based open market buybacks constantly scooping up hype. Then you have HyperEVM fee burns destroying the gas paid on the smart contract layer. And on top of all that, there's the HIP-3 governance proposal. This is a massive move to potentially just burn the accumulated tokens sitting in the assistance fund. We are talking about permanently wiping out roughly $1 billion worth of hype from circulation. The whole thing is an economic machine purpose-built to relentlessly squeeze supply.
Section 4. The battlefield, competitors and looming threats.
Because, listen, when you control the market, you immediately put a massive target on your back. And this brilliantly illustrates that point. Look at this perpetual market share breakdown. Hyperliquid is sitting at an astonishing 70%, leaving former heavyweights like DYDX and GMX trailing way behind in the single digits. Processing over $10 billion daily means they aren't just carving out a neat little niche anymore. They are the venue.
So naturally, you've got competitors backed by major centralized players, like Binance-backed Aster, for example, making these really aggressive pushes to capture that volume. But these older on-chain platforms are severely struggling to catch up to Hyperliquid's raw speed. A slower, general-purpose chain simply cannot compete with a moat built on sub-second finality, zero gas fees, and incredibly deep native liquidity. Actually, the biggest threat looming over them comes from outside of crypto entirely. According to the data, major traditional finance giants like the CME and ICE have actively urged the CFTC to strictly regulate Hyperliquid, and you have to ask yourself, why? Well, it's because Hyperliquid is out there offering anonymous, 24/7 perpetual markets on traditional commodities like oil, operating completely outside of legacy regulatory boundaries. Which sets the stage for the ultimate stress test. It's KYC versus volume. It's a total catch-22. If regulators successfully force Hyperliquid to implement strict know-your-customer rules, or if they force them to block specific markets, it could severely throttle the user growth and that high-frequency volume. And remember that 99% fee buyback engine? Since volume is the lifeblood powering that entire system, a sudden drop in trading means their whole tokenomic structure could just stall out entirely.
So we're left with this really provocative final question. Can this self-reinforcing engine outrun legacy regulators? Hyperliquid has undeniably disrupted the market with sheer speed and absolutely brilliant tokenomics. But will it survive the crosshairs of traditional finance? Or will it end up crippled by the exact same success that turned it into a $16 billion behemoth in the first place? It's a fascinating showdown, and honestly, the outcome is likely going to define the next entire era of decentralized finance. Thanks for joining us for this explainer.